All right, so problem 4. This is the last in the lemon and lime set. And I actually did this on purpose. I didn't give you all of the different items like I've done in the last problems where I showed you, okay, recording realized gain or loss, recognized gain or loss, all that stuff. We're going to be doing that as we go just to keep track of all these items since this is the last one in the problem set. Okay, so number 4, it's the same as 1. Again, I give you 1 because everything comes from the baseline problem of 1. Except assume the fair market value of Lime's building is $700,000 and that Lime owes $200,000 that Lemon assumes. So in problem 1, it was $150,000. Now it's $200,000. Okay? Remember in problem 1, Lemon and Lime, they traded buildings, and then Lemon also took on a liability. Lemon is still taking on a liability in problem 4, but now the liability has been up from $150,000 in problem 1 to $200,000 in problem 4. Also, assume that there's $100,000 of liability associated with Lemon's building that Lime assumes. Finally, Lime pays Lemon $200,000 of cash. Okay, so again, just like in problem 1, we're focusing on Lemon. We're calculating the realized gain or loss, the recognized gain or loss, and the basis of the building received. Those items. So we're going to go through each of these respective items, first starting with the realized gain or loss. Realized gain or loss is amount realized minus adjusted basis. So let's start with amount realized. That's what Lemon's getting. Amount realized is actual cash received plus constructive cash or liability relief plus the fair market value of non-cash property minus selling expenses. I don't have selling expenses on here because, again, in this problem set for like-kind and involuntary conversions, I did not put selling expenses. So we can ignore that, but obviously important for practice. So let's start with actual cash. Actual cash. Is Lemon receiving any actual cash here? Yes. Lime pays Lemon $200,000 of actual cash. So we got actual cash right there. What about constructive cash or liability relief? Yes. Right? We're told there's a $100,000 liability on Lemon's building that Lime assumes. So that's $100,000 of constructive cash. Finally, Lemon, of course, is receiving a building from Lime. The fair market value of that building is $700,000. So Lemon's amount realized in calculating Lemon's realized gain or loss is $1 million. Minus the adjusted basis of all property given up by Lemon. Start the adjusted basis of the property, the building. That's $500,000. Okay. Is Lemon paying Lime any actual cash here? No. There was none in problem 1. There's none in problem 2. So actual cash paid by Lemon is 0. What about constructive cash? Yes. There is a $200,000 liability that Lemon assumes. So the basis of the property contributed by or transferred over from Lemon to Lime with respect to Lemon is $700,000. So $1 million amount realized by $700,000 adjusted basis is $300,000 realized gain or loss. Before we move on to the rest of the problem, I want to note that in problem 1, 2, and 3, which involve Lemon and Lime, you'll note that the realized gain or loss in all 4 is $300,000. But you'll also see that in problem 1, problem 4, 2, and 3 are the same. There's a different recognized gain or loss amount. So it changes. It changes. Even though your realized gain or loss is the same, your recognized gain or loss can change drastically based on what exactly you're getting. Okay? So it comes down to the elements and how all this works out. That was done on purpose. It was purposely done so that there's $300,000 of realized gain or loss in all 4 problems to show you, hey, it changes. Okay? All right. So that's the realized gain or loss, $300,000. So now we move on. The next part is to do the recognized gain or loss. Whenever we do recognized gain or loss, remember the rule that comes to mind in this problem should be non-recognition for like-kind exchanges. So, of course, Lemon and Lime we're focusing on Lemon. Lemon has a building and trading that for another building from Lime. Lemon's holding the original building business, and then the new building is going to be also business. Okay? So Lemon qualifies for like-kind exchange treatment. The problem, though, is that when we look at what's received, hey, we got some boot. We got $200,000 actual cash, $100,000 of constructive cash. So that then spurs the special rule. The special rule says the recognized gain or loss, which, hey, if there's like-kind treatment or like-kind exchange, it should be 0. The special rule says the lesser of the realized gain that we calculated or the boot, which we determine net. Now, before we move on, I want to highlight, because we didn't really highlight this too much in the other problems, that if you have a realized loss in a like-kind exchange here, you cannot have a recognized loss due to boot. That will not happen. You will not have, boot will not trigger that realized loss from actually being recorded. Okay? It's not possible. You can have a recognized loss on a like-kind exchange, but not when you receive boot. That's not a possibility, ever. All right. So that's our special rule. Now, we know the realized gain we just calculated is $300,000. Now we have to determine the net boot amount. Again, we have boot received of $200,000 actual cash, $100,000 constructive cash, but we have to think about our general rule and our special rule with respect to boot paid. So the general rule, remember, is boot paid can offset boot received. There's a special rule that, or exception, we'll say, liability taken on can only offset liability relief boot. Now, in earlier problems, we did not have liabilities taken on with liability relief boot. We didn't have that. We had problem 1 of liabilities taken on. Problem 2, problem 3 had boot. Problem 3 even had boot paid, actual cash boot paid, but not liability taken on. Now we do, right here. So what this is saying is, hey, if you got this, liability taken on boot, you can only offset the amount above it. So what this does is it creates a 2-step process. Step 1, we're going to determine the net liability relief boot. The way we do that is we take liability relief minus liability taken on. So liability relief here is $100,000 minus the liability taken on, which is $200,000. This gives us negative $100,000. So we have net liability relief boot of $100,000. What we then do, step 2, if this number is positive, which it's not, you bring that over. But if it's not positive, I'll just put if negative, it equals 0. This is what we have here. If it's negative, it equals 0. You then are going to add all other boot received and subtract all other boot paid. So here, do we have any other boot received? Yes. We've got $200,000 of actual cash received. So we add that $200,000. Do we have any other boot paid? No. We have no actual cash and no non-cash like-kind property. So 0. So this gives us $200,000 of net boot. $200,000 of net boot. So that's our net boot for purposes of our rule. So the net boot is $200,000. So now we take the lesser of the $300,000 and the $200,000. Of course, is $200,000. So the recognized gain or loss is $200,000. Before we move on, remember, we're going to calculate our suspended gain or loss, which is step 1 minus step 2, $300,000 minus $200,000. Suspended gain here is $100,000. That's going to be important for later on. So now we go to step 3, which is to determine the adjusted basis of the new property. So the new property here is what Lemon is getting from Lime. So the formula is the old adjusted basis plus any actual or constructive money paid minus any actual or constructive money received plus any gain recognized minus any loss recognized. So let's go through this. The old adjusted basis given to us in the problem, also right here, boom, $500,000. Money paid. Sorry, let me put that up a little bit more. My apologies, put that down a little bit too much. Okay, $500,000 is the old basis and the property given up. Plus money paid. We go to our line, the adjusted basis line, we say, hey, there's $200,000 of constructive monies paid or money paid. So we add in $200,000. We subtract away any money received. We've got actual money received and constructive money received. We have both. We've got $200,000 actual and $100,000 constructive. That gives us $300,000 when you add those two together. Again, the actual money received is $200,000 plus the constructive money received of $100,000. That gives us $300,000. Plus gain recognized. We recognized $200,000 of gain. No loss recognized. If we calculate this, 500 plus 200,000 is 700 minus 300 is 400 plus 600. Sorry, plus 200 is $600,000. $600,000 is the new basis. So before we finish this problem, we got to check our work. Again, we're going to assume unrealistically and hypothetically that Lemon is going to sell the new building the next day for the fair market value, which is $700,000. So we take the amount realized, just simply using the fair market value of the new building the next day, ignore everything else. Subtract away the basis, use calculated, which is in step 3, which is $600,000. That gives us $100,000 realized gain, and you're selling for cash, so it's always going to be recognized because there's no non-recognition rule that will apply when you sell for 100% cash. We've got $100,000, $100,000 suspended, boom, they equal. They match, we checked our work. Now, before we conclude, I mentioned earlier, how problems 1 through 4, the $300,000 realized gain and how I set that problem up. I want to conclude this problem, since we're done with the lemon lime problem set, by telling you that each of the problems was created to, every time you go a little bit further with some concepts or steps. You start with the baseline in problem 1, right? You're exchanging just simple exchange. And then as you go, more and more stuff is happening. More liabilities involved or offsetting or whatnot. So the best way to understand like-kind exchanges is to view these 4 problems together. Also, another way to better understand this is that in each problem, there is an important concept that's kind of illustrated. Problem 1 is the baseline for like-kind exchange. Yes, I incorporated the idea of, okay, if we have a like-kind exchange for like-kind exchange, and the only other thing going on is if the party that we're worrying about, our party, Lemon, is taking on liabilities, we pretty much ignore it, other than calculating the basis and determining the realized gain or loss. Because remember, it's going to be zero recognized gain or loss. But problem 2, we then brought into the mix boot. Problem 3, we had boot received and boot paid, but not constructive boot paid. And then problem 4, we had constructive boot paid, and you saw how that made a difference. Now, another thing to note, take notice in problem 4 that, hey, look at step 1 and step 2 for the netting a boot process. We had $100,000 in step 1. We did negative $100,000, which translates to Lemon took on $100,000 more of liabilities than in terms of liability relief and getting liability relief. You're not able to use this negative $100,000 to offset any other boot received. That's how the tax law, the rules are. You have to follow that. It's required. My exam, CPA exam, law school exams, whatever they are, that's how the rules are. That's how the law is. But one thing to note is that you can't use that. That negative $100,000, again, it translates to 0 when you bring it to step 2. So it switches over to $0. Now, fortunately for us, again, the idea here is that this is a non-recognition rule. So for those of you watching the video, you can't obviously see me, but here I'm filming in my class, and I'm actually wearing a costume. I'm wearing this magician outfit. And the reason why I wear this magician outfit is to remind you that non-recognition is not considered an exclusion, right? There's some exclusions in tax, like receiving a gift from the income tax. You don't have to include that in your income, right? It's just simply excluded. There's other exclusions. Life insurance on someone's death, and you're the beneficiary. Municipal bond interest. Those are outright exclusions. You're never going to have to deal with that issue in the future. But remember that with respect to non-recognition, it's a deferral mechanism, right? And I have my magician outfit on, right, with my gold jacket and shiny gold jacket to kind of distract you while I do the tricks, right? And I got my magician hat so I can pull something out of there and then also make it disappear. And I got my magic wand, right? Unfortunately, the $100,000 of suspended gain doesn't just disappear. It gets suspended. And remember, the way that gets suspended is it gets put into the basis. And that's why we do the check your work, because it shows you that, hey, that $100,000 of suspended gain, right, the difference between the realized gain or loss and recognized gain or loss, so basically that $100,000 that you didn't have to record, if you had to record the entire amount, it gets pushed to the future. It doesn't go away, right? That's why we illustrate, hey, if you sold it the next day, the property, well, a sale, everything's going to be recognized, and you have to record the $100,000. So keep that in mind. It's not a permanent, the $100,000 just does not disappear. Now, I will say that in tax, though, there will be times with property transactions where the gain might disappear or lost most of the time. And especially when you deal with things like corporations, corporate tax, okay? That's what I wanted to stress is, again, that this is a non-recognition rule, not an exclusion of this gain or loss. And again, that's why we've been doing the check your work. So I hope you've enjoyed this problem. Watch the later ones as we have a few more that deal with non-recognition.